All right, good evening, everybody. How is everyone doing tonight? Thank you for coming out. This is a very exciting seminar to put on for everybody. This particular seminar highlights our core strategy that we utilize with 90% of our clients. The nice thing about this seminar is we don't talk about any specific investment product. Some of you are probably here tonight hoping you'll learn about the latest and greatest, hot tip of the day, make money fast type of thing. That's not what this seminar is about. This seminar is all about showcasing three very important concepts that we educate our clients on. And on top of that, we take those three concepts and we weave those concepts into a very powerful strategy called the bucket system. We're going to showcase that for you here tonight. So that's pretty exciting. My name is Ben Paul. I'm a financial advisor here at the Trinnell Financial Group, and I also serve on what's called the Liberty One Investment Committee. That investment committee is an in-house committee made up of 6 different individuals that manage a series of portfolios that we put together for our clients. We do have a seminar called Tactical Income Solution that showcases one of those portfolios that we put together. This seminar, we're not going to talk about any of those portfolios, but I'm sure you'll see as the strategy develops in front of you, you can certainly see where different portfolios will fit into place. So that'll be really neat to walk you through. Our mission at the Trinnell Financial Group is to help our clients enjoy a better life. At the end of the day, it's all about giving you guys clarity and confidence about the future. I absolutely promise you that I can talk anyone in this room to sleep when it comes to finance. In this business, there is a lot of jargon, a lot of technical numbers we can run for you. I can put all sorts of pretty charts, whether they're pie charts or line charts, up on the screen behind me, and I can knock you right out. I promise you that. Okay? Our role as financial advisors is to take everything we know up here, all that jargon, all that technical stuff, all those things that are really confusing, take all those things and package them in a way that gives you clarity and confidence about your future. Is it fair to say that when it comes to finance, a lot of the general public doesn't know what they don't know? You know what I mean by that? There's a lot of wonder out there. That's why you guys are here tonight, to get some answers, to get some clarity, to get some confidence in things. I bet a lot of you are retired or soon to be retired, and you're looking for guidance. You're looking for a path. It really comes down to confidence and clarity about what your future can look like. That's what this seminar is going to be all about. You will leave here tonight with a lot of clarity and confidence about your future and what it could look like. We carry out our mission right here, 1509 North Milwaukee Avenue. Been in business here for 26 years, right here in Libertyville. We have a fantastic team. We have 26 full-time employees. This is just a few of the headshots on the wall behind me. We also do something pretty cool here called the Taste of Life program. During the summer, we'll have anywhere from 6 to 8 interns working for us at any given time. The goal of that program is to give these interns a taste of the real world, taste of life. During the summer, some of these interns are here every day, 5 days a week. Some interns come in on Monday afternoons or Thursday afternoons, what have you. That's just our way to give back to the public, and it's our way to bring new people up in this industry. Very rewarding, a lot of fun for us as well. That group of people you saw behind me, we manage collectively about $300 million in client funds. We have relationships with several large financial institutions in the area, mainly Great Lakes Credit Union, National Bank and Trust, and Itasca Bank have all elected to partner with us to provide these full-service financial planning services to their customers and their members. So that's really, really exciting. We are truly full service. This is really important. We are full service. When it comes to financial planning, there's nothing we can't do. We can do investment planning, tax planning, estate planning, life insurance, cash flow planning, college retirement or college savings, retirement planning, you name it, we can do it. All these services offered under one roof is very, very powerful. The best part about these services is we offer them on a completely independent basis. I'll explain what I mean by that. If I was a Fidelity financial advisor, you would come to my Fidelity office and I would recommend a bunch of Fidelity mutual funds to you. If I was a Vanguard representative and you came to my Vanguard office, I'd have a bunch of Vanguard funds to recommend to you. Prudential, same thing. Come to my Prudential office, I'd have a bunch of Prudential insurance policies to recommend to you. The nice thing about Money Concepts is we can offer literally any stock, bond, mutual fund, annuity, REIT, you name it, we can do it as long as it's not proprietary. Pretty neat stuff. Quick show of hands, who in this room has ever heard of Money Concepts before? Okay, the few of you who are clients, I see you raising your hand. The rest of you, Money Concepts is a brand new name for you. That's normal. Most people outside of our client base have never heard of Money Concepts. That's because Money Concepts allows their financial advisors to self-brand the name of their business. So Rock Trinnell, the Trinnell Financial Group. Rock Trinnell is a Money Concepts rep who opened up a Money Concepts office, but because Money Concepts is independent, Rock can call his business whatever he wants. He doesn't have to call it Prudential. Doesn't have to call it Fidelity. He can call it the Trinnell Financial Group. So Money Concepts is the body behind scenes that makes all this possible. The Trinnell Financial Group is the company licensed through Money Concepts. Offering all these great services and all these services on an independent basis is great, but all those services are only as good as the systems and the people that back it up. So we have a trademark process that we conduct here with all of our clients called the Faithful Watch Program. It's a way for us to get together with our clients on a semi-annual basis and review all the different disciplines you see here on the screen behind me. Tax planning and cash flow and investments and risk and all those things. Raise your hand if you're working with a financial advisor currently. Okay, about half of you. Okay. And I would wager that those of you who just raised your hand probably don't meet with or see your advisor all that regularly. Is that fair to say? Now, I know some of you probably meet more often than others, but some of you may not have even heard from your advisor since you opened the account with him or her. Okay? This is a proven process, a program that all of our clients go through that takes all these different disciplines into account on a regular basis. Really, really neat stuff. So like I said, clarity and confidence about your future with the ultimate goal to help you enjoy a better life. That's our mission here at the Trinnell Financial Group. That's one of the main reasons that I work here, is because we talk about this mission every single Monday at our big staff meetings. It's not about the numbers and the pie charts and the projections and all those fancy things we can do. It ultimately comes down to how we execute on those things, how we use those different things to give you clarity and confidence about your future. If you would please, really quick, you all have a folder in front of you. If you could pull out that folder, on the left-hand side, right on top, you'll see there's an evaluation form. Behind the evaluation form, there's some note pages. Pull the note pages out, pull your pen out. We're about to get into the meat of the presentation here. I'm going to walk everyone through this evaluation form at the end of the seminar. But here's what I want to say about the eval form before we even get into the meat of the presentation. Can anyone guess why we do these seminars for the public? Any ideas? To get clients, right? Exactly. We recognize that it is very intimidating for someone to just walk in off the street, come meet one-on-one with a financial advisor, not really knowing what they're about to walk into. You know, if it wasn't for this seminar and you just came to meet with me, you don't know what I look like, you don't know what I sound like, you don't know what our philosophies are, you don't know what our strategies are, you know nothing about me. These seminars are a way for you to get to know me, to get to know our firm and the processes and the systems that back me up. You get to know me, what I'm all about, what I stand for, what my strategies are. It's a very safe way for you to meet an advisor without being quite so one-on-one and so intimidating that very first meeting. So it's a really, really good icebreaker for us. You get to size me up, see what we're all about, But ultimately, my hope is that you find the content that you're about to see so compelling that you want to set up a time to meet with me and really dive into the details of your own personal situation. That's my goal here tonight, is to basically win you over to want to sit down and meet with me and take this relationship to another level. So at the end of the seminar, when we go through the eval form, I'm going to ask you to do one of two things. Either write your phone number down on the sheet or don't write it down. If you write the phone number down, I will call you, I'll follow up with you, and we'll set up a time to get together. If you don't write your phone number down, I won't bother you. Okay? I'm not here to hound you. I'm not here to twist your arm to meet with me. All I ask is, if you find this information worthwhile, if tonight was well worth your time, jot your phone number down and we'll set up a time to get together. Okay? It can't hurt one bit. All right, into the meat of the presentation. What we're going to talk about here today, we're going to talk a little bit about emotions. We're going to talk about three very important concepts: time horizon, sequence of return, and dollar cost averaging. And then we're going to talk about the bucket system, the core strategy. So those three concepts, time horizon, sequence, and dollar cost averaging, will all bleed into the strategy. But the first thing I want to do is talk about emotions a little bit. Is there a lot of emotion tied to money? Of course, right? There's a lot of importance placed in money. When I sit down and talk to somebody for the very first time, I like to pull out what's important to them. What are they trying to accomplish? What's important? What's important to them usually comes down to health, family, money, and religion, depending on who you're talking to. So health, family, and money. Money's right up there. Money allows us to do the things we want to do when we want to do them, buy the things we want to buy, give money to people we want to give money to, whatever those things are. Money is what makes doing stuff in life possible. All the necessities and then some. So money is important. There's a lot of emotion tied to money. Is it fair to say that the pain of losing money is twice as great as the joy of making the same amount? Okay? So think about that. If you lost $10,000, that would really hurt, right? $10,000 is a lot of money. I know some of you in this room probably had 401ks in 08 and 09 where you lost $100,000 or more. That hurts, doesn't it? A lot of emotion tied to that. Well, if you made $10,000 or you made $100,000, yeah, that's nice, that's exciting. There's some joy in that. But the pain of losing it is twice as strong as that joy of making it. Because once you have it, it's not fun losing it. Once you have it right there in your hand. So there's a lot of emotion, good and bad, when it comes to money. This slide here, markets have been a little erratic this year. I've been using this slide for the last 10 years. The point of showing this again this year is to tell you that markets have always been erratic. They're always going to be erratic. You're not going to change that when you work with a financial advisor. There are going to be ups and downs no matter what. What you need, though, is a strategy, like we're going to talk about here soon, a strategy that takes the emotion of the ups and downs off the table. We'll talk about that here in a second. Think about last year. We had ISIS, big problems. We had Ebola, caused a big problem. The slowdown in China and Japan, big problems. There's always going to be stuff that makes the markets erratic from month to month, quarter to quarter, year to year. That's not going to change. What you can change is the strategy you employ to help combat this. So let's break down emotions a little bit here. Markets tend to cycle. They tend to go up, they tend to go down, and there's all sorts of emotions that are caught up in those ups and downs. Let's think back to the recent real estate bubble that just popped. So think back to 2005, 2006, part of 2007, real estate was going up like crazy. Everyone's house was going up. Every other show on TV was Flip This House back in 2006, 2007. Everyone was thrilled. Everyone was elated. everyone and their brother wanted to get in on it. Buy a second home in Florida. How could you lose? How could you lose? And then all of a sudden we started hearing some chatter about lending standards, letting people into these homes with mortgages they couldn't afford, and interest rates that were starting to adjust, and payments were starting to get higher. And all of a sudden these people couldn't afford to make their payments. So they started to default on their loans. And then there was some acceleration of this as that all started to snowball. And all of a sudden, people weren't making their loan payments. And all of a sudden, the banks that were backing these loans were in big trouble. And then all these people couldn't make their payments, and people started getting laid off because there was fear in the economy. And then with people getting laid off, even more people couldn't make their payments because now they're not even working. And the bubble just popped and everything crashed. And then here we were down here, in pretty bad shape. And now we've kind of been in this recovery ever since for the last 4 or 5 years. Same thing happened with the dot-com bubble. Everyone and their brother was talking about the latest and greatest internet stock. Oh, by the way, there's no earnings backing up any of those share prices, so it's going to crash, it's going to correct. Right? This is always going to be happening. Now here's what's interesting. When everyone and their brother is running into something, like real estate or internet stocks, when everyone could not be more excited about how things are going, that's the greatest risk. That's when the market's at its highest point. When everyone is scared and frightened and wonders, is it ever going to end? Is the pain ever going to go away? Are we ever going to recover from this? That's the greatest opportunity. Warren Buffett has a saying. He says, be greedy when others are fearful, and be fearful when others are greedy. So when everyone's greedy, that's when you need to be fearful. Because when it doesn't seem like you possibly get any higher, well then what's left to push the market up? Can't help but go down. He says be greedy when others are fearful. When everyone's panicking and everyone wants out, there's nowhere else but up to go. That's when you get in, because that's when you capture the upside. Okay? You have to take the contrarian point of view. Emotions will always tell you to do the exact opposite of what you should do with your money. Almost like clockwork. When your emotions tell you to buy something because it's done so well, that's probably what you shouldn't buy. You should find what did this and buy that, in general. But you can pretty much play by that rule. Other than health, family, money, and religion being important to people, when it comes to retirement planning, these types of questions have a lot of emotion tied to them. When it comes to retirement planning, the number one concern, do I have enough money to retire? Will I run out of money? We all want to outlive our money. Is that fair to say? We don't want our money to be gone before we are. That wouldn't be much fun. You need to have as much money. You need to have enough money to live your life the way you want to live it for as long as you're going to live it. Will I run out of money? Number two, am I maximizing my potential? This is a neat emotion that clients feel. It's a real emotion. It'd be a shame to work somewhere for 20, 30, 40 plus years, sock money away in a 401k, retirement plan, Roth IRA, sock money away for all these years, and then not get everything out of retirement that you want to get out of it. Most of us have a bucket list of some sort that we want to accomplish, things we want to do, people we want to spend time with. It takes money to do those things. If you want to travel more, spend more time with the grandkids, buy a second home in Florida, buy a camper and tour the country, whatever that stuff is, if you don't do that, that would really be a shame, right? You want to get as much out of retirement as possible. That's why you saved all these years and worked so hard for all these decades so you can do that. The third one's really interesting. Up until 2008, 2009, this really wasn't top of mind for people. But with the crash that happened in 08 and 09, this really is top of mind. People don't want to be so worried about their finances that they can't enjoy retirement. I've got a client of mine, his name is Jack, and I call him up on the phone, usually to schedule our Faithful Watch reviews, And almost every time I call him, like clockwork, I can hear CNBC on in the background, the Money Channel. He's listening to what the markets are doing. And I joke with him. I say, Jack, you're never going to look back on life wishing you watched more financial news. You are retired, you have money, go out and enjoy life, spend some money, maximize your potential. I'm going to make sure you don't run out. Just get out there and live life. Watching the news doesn't change the outcome of what the markets are going to do. It's my job to take what's happening and help you make really good decisions. You sitting there watching it every day doesn't change what's going to happen. So you might as well live your life and let us worry about what's going to happen, because you can't change it by watching the news. That's a very legitimate concern that I help a lot of clients overcome. Just live life, stop worrying about it, let us worry about it. That's our job. All right, with that said, I'm going to transition now into the first of three concepts. This is really the meat of the presentation. The emotional stuff you just saw me do is really important, because you're going to see how this final strategy is going to take all those emotions off the table. Before I get to the strategy, like I said, I'm going to take you through three different concepts. These are very important concepts. I guarantee you've never thought of these concepts in this way before. I'll show you. The first concept is time horizon. Now, some of you might be thinking, geez, I already know what time horizon is all about. Long time horizon, I can be aggressive. Short time horizon, I can be conservative. That is true. That's the spirit of what time horizon is all about. But I'm telling you, in retirement, you need to think about time horizon completely differently. Let's pretend you're 60 years old sitting in this room. I know for some of you, you'd take 60 any day, and for some of you, 60 is overshooting by about 20 years. I know we have a wide range of audience members in this room right now. But just pretend you're 60. Let's say you're 60 years old, and you want to retire when you're 65. What's the time horizon on your retirement money? How long?
5 years.
All right, 5 years. Most people say 5 years. The time horizon on your retirement money is not the day you're going to retire. It's the day you're going to pass away, because that's how long you need your money to last. So many of us who are about to retire think of their time horizon as the day they're going to retire. So at age 60, with retirement at 65, you think to yourself, oh my gosh, I'm about to retire. It's only 5 years away. I need to get really, really, really conservative with my money. Now, still stay in the frame of mind of being 60. If you were 40 years old, so if you were 20 years younger, would you be as worried about your money as you are today? Of course not. Why aren't you as worried when you're 40? Because you got time on your side. You view yourself as having 20 years till you retire. Well, if you're 60 today, isn't some of the money you have not going to be used for 20 years? Right? So retirement is a series of staggered time horizons. Some of the money you have in your nest egg won't be used for 5, 10, 15, 20, God willing, 30 years. It doesn't make sense to manage your 20-year money the same way you're going to manage your 5-year money. Two completely different time horizons. But we all mentally lump our nest eggs into one bucket, and we say, this is my retirement money, it should all be managed the same way, when in reality, your retirement money is over a series of time, and you should stagger your time horizons and manage different chunks of your money in different ways. I've got 2 kids. I've got a 5-year-old named Brady and a 3-year-old named Madeline. When they were born, I opened up college savings plans, so when they're born, 18 years till they go to school. With 18 years to go, I can be pretty aggressive with that money. When they're in middle school, I'll be more balanced. When they're in high school, I'll be pretty conservative. The nice thing about knowing retirement money or college savings money is the time horizon is very defined. They're going to basically start using it when they're 18 and probably stop using it when they're 22, 23, 24, depending on the level of schooling that they get. Very defined, very easy to manage time horizon. Retirement planning isn't like that, because none of us know how long we're going to live. so we don't know how long it needs to last. I'll show you how we get around this here once we get to the strategy. The next concept is sequence of returns. This is actually my favorite concept when it comes to the seminar that you're seeing here. Sequence of returns is pretty cool. When it comes to a person's financial life cycle, we basically divide a life cycle into two stages: accumulation phase and distribution phase. The accumulation phase is when you're saving money for retirement. You're accumulating money, hence accumulation phase. Distribution phase is when you're living off your money. It's when you're already retired and you're distributing money to yourself. Distribution phase. You're living off your money. Sequence of returns, which I'm going to explain here in a second, affects these two different phases drastically different. I'll show you what I mean. On the screen behind me, you'll see years 1 through 15, and you'll see someone started with $100,000. 15 years later, they had $280,000. They earned this random sequence of returns over that 15-year period that grew their money to $280,000. This sequence does not represent any particular investment. It's just some random numbers. What I want you to notice about these numbers, though, and this is really important, is the first 3 years were very, very good, and the last 3 years were pretty bad. And that 100,000 turns into 280. My question to the group is, if you took those exact returns and you flipped the returns end for end, how would that change the end result? Higher, lower, what do you guys think? Okay, I hear a little mix of everything right now. The answer is, it's exactly the same, 280,000. Notice what happened here. The -8 is now at the top, the 22 is at the bottom, flipped end for end, and the exact same answer at the end. How does this work? How is this possible? Think of it like this. 3 times 2 times 1 equals 6. So does 1 times 2 times 3, 2 times 3 times 1, 2 times 1 times 3. No matter what order you multiply those numbers in, the answer is always 6, and the average is always 2. With this slide, all you're doing is multiplying by percentages. You could mix those percentages up any order you wanted to, and you'd still end up with 280,000. Same concept as this. It's the same average, it's the same answer every time, no matter what order that comes in. Now, for those of you who have retirement plans or 401ks at work, 2008, 2009, you saw some downturns in your account. Is that fair to say? To say the least, right? Saw some downturns. You don't have to raise your hand. This is a rhetorical question, but I'm guessing that there are some people in this room that when the markets went down, you pulled out and went to cash with your investments. Okay? I can see some of you nodding in your head that you probably did that. You did that because the emotion tied to the account going down is very strong. You want to stop the bleeding. That's painful to lose that money, like we talked about earlier in the seminar. But when you step back and realize that you're going to have bad times, you're going to have good times, and when you think of your time horizon as being 20, 30 years when you're 50 years old, instead of 5 or 10 years, then you let all this stuff just kind of iron itself out, and you realize the individual years don't matter. Only the average matters. You're going to have good times, you're going to have bad times. The only thing that matters is the average. The end result is the same. When you realize that 08 and 09 were just 2 years out of a long 60-year sequence that you're going to have, it all irons out in the end. So, accumulation, distribution. Here's the thing. What you just saw only holds true in the accumulation phase, when you're saving for retirement. The distribution phase is completely different. I'm going to review accumulation one more time. I'm going to go through it quick, because I know we just covered it, but I want to tell the story. So here's Andy. Andy is 40 years old, investing $100,000. 41, 42, 43, he receives 3 bad years in a row. Poor performance. He receives some really good years in the end. Over this 25-year period, averages 8% a year, and his $100,000 turns into $735. Beth has the exact same returns as Andy, but flipped end for end, just like the concept you just saw on the previous slide. Her $100,000 also turned in to $735. Same outcome because they averaged the same amount over the same period of time. Andy and Beth are in the accumulation stage. They're saving money for retirement. They're accumulating money. But watch what happens in the distribution phase. They both retire. They roll their $735 over into an IRA. And this is important. Make sure you hear this because it's important. They're withdrawing a 5% income stream from their nest egg. So they're withdrawing money on a regular basis to complement their income, to supplement Social Security and or pension. Now, they both averaged 8%, just like they did over here. Even while averaging the same amount, Andy is broke at age 84, and Beth has over $3 million at age 90. And they got the exact same average return. So what happened? How can this be? Well, Andy, in year 1, was negative 12%, just like over here. In fact, the returns Andy and Beth get on the distribution side are exactly the same as they get on the accumulation side, just so we can do a pure apples to apples. So Andy, in year 1, lost 12% in value, and remember, withdrew 5% on top of that. So really the account's down 17% year over year. In year 2, Andy lost 15%, and oh, by the way, took out another 5%. Again, compounding the account in the wrong direction. Beth, on the other hand, had some spectacular years. In year 1, she earned 29%. So when she withdrew 5%, she was still up 24%. She still made money. It's a good thing. Same thing happened in the second year and the third year again. 3 really good years in a row. Look at the drastic difference right here. When Andy's 73, he has $354,000, and Beth has $1.5 million, almost 1.6. Let me look at these differences. At age 75, there's a $1.7 million difference. That's crazy. And they both average the same return. So many clients will come in and they'll meet with me, and they'll sit down with me for the very first time, and they'll say, hey, what have your clients been averaging? What's your average return here at this firm? The return is pretty much irrelevant to the outcome for the most part when it comes to your income money, your distribution money. Because here you can see 8%, totally different outcome. The average return isn't what mattered. The volatility, the control of the volatility is what matters. In retirement, you should be willing to accept a smaller return with less volatility instead of a higher return with more volatility. You should want a 6% steady return over an 8% choppy return any day. Because when you look at this, and a financial advisor, they sit you down and they'll say, hey, you know what? This portfolio over the last 25 years has averaged 8% a year. You're going to withdraw 5%. How can you go wrong? How could you lose? Earn 8, take out 5, you're good to go. Sign me up, right? Where do I sign? That's not how it works, because you can't control the volatility. Projections are irrelevant because it's not about what the projected average is. It's about the volatility along the way. So the emphasis needs to be on keeping your returns reasonably steady, controlling your range of outcomes as you go. That's really important. Again, we're going to tie all this together here very soon. The last concept, before we get into the core strategy, the last concept is dollar cost averaging. This is a pretty neat concept too. Imagine sitting down in my office, and you come into my office, you say, Ben, I want to invest $50 a month with you. I say, great. Which investment would you like? The blue investment or the pink investment? Now most clients, and you guys probably are thinking it too, you want the blue investment. But now you know that there's a method to these slides, and if the answer was easy, I wouldn't be giving a seminar on it, right? Okay? The pink investment makes you the most money. If you're adding money regularly to an account, you want volatility. It will make you more money. Now hold on a second. Think about what I just said. I just talked about sequence of returns, and when you're retired, you want to limit your volatility. And now here I'm telling you, if you're adding money to an account regularly, you want some volatility. So I realize I'm contradicting myself. Like I said, I'm going to tie all this together here very soon. Okay? When you're adding money to an account, volatility can often make you more money than the slow and steady. I'll prove this to you. Both the pink and the blue investment start at $10 a share. Like clockwork, the blue investment goes up 50 cents every period. Never has a down day. Every month it is 50 cents more expensive than the month before. Making some money. The pink investment starts at 10, never gets above 10 ever again, and just happens to end up at 10 when it's all said and done. The blue investment, as it gets more expensive, your $50 per period buys you fewer shares. So when it skyrockets to $17 a share, your $50 buys you 2.9 shares. When it ends up at $21 a share, your $50 gets you 2.4 shares. When it's all said and done, you accumulate 80.2 shares times 2150, $1,724. The pink investment, as it falls in value, your $50 gets you more shares. At $3 a share, you get 16.7 shares. At $7 a share, you get 7.1 shares. When it's all said and done, you would have accumulated 199.3 shares. Yes, it's only worth the original $10 starting price, but your total account value at that time is $1,992. When you think about it, that's pretty amazing. The pink investment never got above the original $10 price, and you made more money with the pink investment than you did with the blue one. That shot up to $2,150. Let's break this down, take it one step further. Let's say you buy one share of something at $10. How much did you just spend? $10. A month later, it falls in value. Falls in value to $5. Just lost half your money, right? Your $10 investment fell to $5. But what if instead of just holding it, you bought another share at $5? You bought at 10, you bought at 5. You bought 2 shares. Your total cost is $15. Now, at this point in time, how much money is in your account? At $5 a share, you have 2 shares. You have $10 in your account. $5 a share, 2 shares. You have $10 in your account. You paid 15 because you bought at 10, you bought at 5. Where do you get your money back? At what point? Where's your break even? Break even's at $7.50. Because at $7.50, your 2 shares are worth $15. Anything above $7.50, you're making money. So when it gets back up to $8 a share, you have $16 in your account. You put 15 in, you made $1. When it recovers back up to the full $10, your 2 shares are worth 20, you made $5. That's pretty good. Now when you think about it, to turn 15 investment into 20, that's a 33% return. 33% return on your money, and you broke even on your original price. Never got above where you started. You make 33%. It's called dollar cost averaging because every time you buy a share, you're changing your average share price. Average dollar cost averaging. Every time you add a dollar, you're changing your average cost. Dollar cost averaging. The average of 10 and 5 is $7.50. That's all it is. Whenever your price is above its average, that's you're making money. That's all you need to do. You know your average price. Anything above that price, you're in the green in terms of making money. It's pretty neat. All right. So what should you do? We talked about emotions. A lot of emotions tied to money. We talked about how emotions will usually have you do the wrong thing with your money at the wrong time. We talked about time horizon, how retirement planning is really a series of staggered time horizons, not just a lump sum of money. We talked about sequence of returns and how sequence of returns doesn't matter in the accumulation phase, but it matters a lot in the distribution phase. And we talked about dollar cost averaging. So how do we take all these emotions, all these concepts, and really wrap them all together into a core strategy, a core system? That system is called the bucket system. What we do with 90% of our clients is we'll take a client's nest egg, their retirement money, and divide it up into two buckets, a growth bucket and an income bucket. Now the names are pretty self-explanatory. We're going to take an income stream from the income bucket, and we're going to put money in the growth bucket to just set aside and let it grow. How much goes in each bucket depends on what your goals are, what you're trying to accomplish. Ideally, in retirement, your fixed income at least matches your fixed expenses. So let's say that you need $5,000 a month to live retirement comfortably. Well, if Social Security gets you $3,500 and you need $5,000, then you need to put enough money in the income bucket to make up that shortfall, to make ends meet in retirement. So the exact amount that goes into each bucket depends on your individual situations. For sake of this presentation, we're going to use a starting nest egg value of $500,000, and we're going to divide the nest egg into growth and income, $350 and $150. Now, some of you are in this room right now looking at that $500,000 figure and thinking, holy cow, that's a big number. And some of you are in this room right now thinking, is that all? Right? So I know everyone in this room is at a different stage of their life financially. I'm using $500,000 simply for sake of an example. We can do this strategy with $50,000. We can do this strategy with $5 million. It doesn't matter. I want you to understand the strategy. The income bucket, we're going to take a 5% income stream from that $350,000. That comes out to $17,500 per year. So you have your income bucket, and this is the annual income that's going to supplement your other income sources. It's going to supplement your pension, it's going to supplement Social Security, etc. Is this money pretty important to you? The $17,500? Is that pretty important money? Of course it is. It's how you pay your bills, it's how you live your life. That's important. With this money being pretty important, it's fair to say that this money is pretty important, because this is what generates this. So with this all being pretty important to you, are you going to be pretty aggressive with that money or pretty conservative with that money? Right, conservative. On a scale of 1 to 10, with 10 being very aggressive and 1 being very safe, this is going to be like a 3 or a 4 on that scale. You're going to be moderately conservative with it. You're not going to throw it all in a CD and earn 0.5% and think that that's going to work taking out 5% a year. So you're not going to be ultra conservative, but you're also not going to throw it all in Facebook stock either and hope for the best. You're going to be moderately conservative with that money. Now this money over here, can we say for income purposes, when it comes to this, that this piece here has nothing to do with what happens down here? This growth bucket is really out of sight, out of mind. What happens in the growth bucket has no bearing on your income from month to month, from year to year. So with the growth bucket being completely irrelevant to your income, can we be a little more aggressive with that growth bucket? Of course, right? On that same 1 to 10 scale, this is like a 6 or a 7. Moderately aggressive. Not crazy, but moderately aggressive. You want to make some money over here. You want that money to grow. That's the whole idea. Now, look at what we just accomplished. We did a few things here. By dividing the money up into 2 buckets, the first thing it allows you to accomplish is it gives you a place to go get money when you need extra cash. Pretend for a moment that this income bucket was the only money you had. And all of a sudden an emergency came up, an emergency above and beyond your cash flow. You need $20,000 for something. New roof, new car, medical emergency, whatever. You need $20,000. If this is your only account and you tap into this for $20,000, now you've got $330. Now you're taking 5% from a smaller number. You just gave yourself a pay cut. That's the last thing you want to do in retirement. By having this growth bucket here, it gives you a place to go get money for emergencies without affecting your income stream over here. So that's really important. It gives you a safety net to draw from without affecting the income stream that you need to live your life. Now, that's the easy part. The next part is really the cool part about this whole strategy. We want the growth bucket to grow. So let's turn that 150 into 200,000. You just increased it by $50,000. Now watch what we do here. We take the gains from the growth bucket, slide the gains to the income bucket. When you do that, you move that $50,000 over like you just saw, you give yourself a raise. Because now you're taking 5% from a bigger number. So we give ourselves a raise and we protect our gains. So I'm going to slow down here for a second and think about what you just saw. The gains from the growth bucket fed the income bucket, which feeds the bottom line. So we give ourselves a raise and we protect our gains by moving the gains from the more aggressive bucket to the more conservative bucket. So you gave yourself a raise and you protected your gains. That's really powerful. The gains from the growth bucket feed the income bucket, which feeds the bottom line. It's how you give yourself a raise. Emotions. Think about that chart you saw with all those emotions on that scale, from being very excited, very elated, to being very upset, being very scared. Warren Buffett's saying, be greedy when others are fearful, be fearful when others are greedy. When markets are going up and everyone's really happy and excited, what should you do at that point? That's when you sell, right? Lock in those nice gains. Protect those gains. When you move the gains from here to here, you're protecting them because you're going from aggressive to conservative. Now, some clients raise their hand here and they'll say, well, Ben, what if the market keeps going up? If the market keeps going up, that's great. You still have 150 working for you. If it goes down, you'll be glad you moved the 50,000 over. You can't lose. You either keep making money or it goes down and you're happy you did it anyway. Either outcome is okay. helps with emotions a lot because it really forces you to bring that money over, protect it, and give yourself a raise. Market keeps going up, good. If it doesn't, you're still okay. You just gave yourself a raise. Let's talk about time horizon. We talked about how retirement is a sequence of staggered time horizons. You're not going to invest your 5-year money the same way you're going to invest your 10, 20, 30-year money. Your growth bucket is your long-term money. That's your down-the-road money. You can be more aggressive with the growth bucket because it's longer-term time horizon. The income bucket, that's your here and now money. Your income bucket is generating income for today. You don't want to be very aggressive with that money. You want to be moderately conservative. So in this bucket, you're going to be moderately conservative. You're staggering your time horizons, therefore you can stagger how you're invested in each account. Really neat stuff. Sequence of returns. This one is important. This is my favorite concept, as I mentioned. In the accumulation phase, the order doesn't matter, just the average. Remember the Andy and Beth stuff we talked about? How you flip the returns and the end result is the same as long as you're in the accumulation stage. Now some of you are thinking, well, Ben, I'm retired here in this scenario. I'm in the distribution phase, you're thinking. This money is in the distribution phase, but this here is still in the accumulation phase because you're not taking income from it on a regular basis. You're only going to draw from it when you protect the gains. That's different. This money here, the only thing that matters is the average. The volatility does not matter in the growth bucket. Only the average matters. That's what makes the fluctuations in this account okay. Because the fluctuations don't affect the outcome. Only the average affects the outcome. The income bucket is a different story. The income bucket is in the distribution phase. You're distributing, in this case, $17,500 or $20,000 a year from that bucket. You're distributing money to yourself. So on the income side, the sequence of return does matter. So what do we need to manage in the distribution phase? We need to manage volatility. How are we managing volatility? By being moderately conservative with that portion of the money. So it solves that problem. It gives you a place to be aggressive, to be moderately aggressive, where volatility doesn't matter. That's the growth bucket. It gives you a place to be conservative, where volatility does matter. And that's the income bucket. Dollar cost averaging. In my example of dollar cost averaging, I referenced adding $50 per month to an investment. Whether it's a 401k, IRA, brokerage account, what have you, $50 a month. And now here we are again with a retirement scenario, and you might be thinking, well, if I'm retired, I'm not working, I'm certainly not adding to a 401k or an IRA anymore, what am I going to dollar cost average with? Well, over here, in the growth bucket, you're reinvesting your dividends. So every month, you're reinvesting dividends into what you own, buying every month regardless of the price. Like in that pink investment, it goes up and down, and you're buying regardless of the price. Constantly buying into what? A more volatile investment, like in the growth bucket. It's all by design. The growth bucket's a little more volatile. That's okay. It's moderately aggressive. You're going to reinvest your dividends into that more volatile investment, and that's going to make you more money than you would if it wasn't as volatile. All those things we talked about. So will I run out of money? Let's circle back to these emotions. This is what I'm talking about when it comes to our job in this industry. It's not about the fancy charts. It's not about the fancy line graphs. It's about taking what we know about this area of the business, about finance, and taking these concerns off the table so you can enjoy a better life, so you can have that clarity and that confidence about the future. Do you see how this system gives you a way to not run out of money? When the gains from the growth bucket feed the income bucket, which feeds the bottom line, not only is the system self-sustaining, but you have built-in raises in your portfolio as you go. So you have some natural built-in cost of living adjustments. Am I maximizing my potential? This is really cool. Let's say one of the things you want to do is take the grandkids to Disney World. Big family trip. Let's say that trip's going to cost you 20 grand, $20,000. Well, when you have that $50,000 of gain in the account, you don't have to move the full $50,000 of gain over. How cool would it be if I call you up and say, "Hi, Mr. Smith, just wanted to let you know, going to be bringing you in for your semi-annual Faithful Watch review, your account review. You have a really nice $50,000 gain in your growth bucket. Is there anything that you want to earmark some cash for in the near term?" And you say, "Yeah, you know what, I want to take the family to Disney World." Or, "You know what, I've been meaning to put a new patio and new deck on the back." Or, "I've been meaning to remodel the bathroom upstairs." And I say, "Great. How about we'll tuck $20,000 away into an IRA money market so you've got it when you need it for your Disney trip, and we'll just move $30,000 over to the income bucket. You still get a raise, you're still protecting your gains, and you have all that $20,000 set aside for that thing you want to do, whatever it is." That's how you maximize potential in retirement. That's how you get everything out of retirement that you want to get out of it. And third, will I be so worried about my financial life that I can't enjoy my retirement, enjoy my life? The only part of this system that's going to be reasonably volatile is the growth bucket, because it's moderately aggressive. But like we talked about, does the up and down over here matter at all to you in terms of day-to-day living? It doesn't. It separates you. In fact, when we had our 2008, 2009 crash, clients don't have to take pay cuts with their income bucket because that's not designed to be volatile. If this goes down to 125 before it goes up to 200, that's okay. It's okay if it takes 2-3 years for that to happen. It doesn't affect how you live your life. And then when it does go up, when this growth bucket does grow, take the gains off the top, shift them over, give yourself a raise, market goes down again, this goes down, so what? You just gave yourself a raise, protected the gains you already had, you've got 20 grand in the bank to go to Disney World. How is that a problem, right? That's pretty neat, how that all comes together. So what's the next step? Next step is you need a plan. Planning is absolutely key. We need to figure out how big this bucket needs to be for your personal situation. Don't just look at this like some theory, like some, "Oh, that would be nice if I could figure that out." Look at this like you want a plan to make this happen. How much income do you need in retirement with inflation adjustments built in? How much income do you need to live the life you want to live in retirement? Once you know how much income you need, then you know how big the income bucket needs to be. And once you know how big the income bucket needs to be, then you know how big the growth bucket needs to be. All this is connected. But it's not just about your investments. And you don't just need any type of plan. You need a comprehensive plan. A plan that takes far more than investments into account. You need tax planning and estate planning and income planning, retirement planning. A lot of my clients want to set up some 529 plans, some college savings plans for their grandkids. It's our job as financial advisors to be right in here, right in the middle of all this with you, coordinating all these different pieces. Because how your investments perform, does that affect your estate plan and how much money you're going to leave behind? Of course. Do how your investments perform affect your tax situation? Of course. If you're taking Income from your IRAs, is that taxable? Does that affect your tax bracket? Of course. All these disciplines are connected. So many people think of their investment person as this person. We are this person, but we're also so much more. Our job is to be right in here with you, right in the middle of all this. So you need a plan, you need a comprehensive plan, and third, you should put the plan together with a professional. That's really important. Like I talked about when I opened up the seminar, and I kind of rhetorically mentioned to the group, in this industry, the general public, you don't know what you don't know. Raise your hand if you're up to speed on all the 2015 estate tax law changes this year. Show hands quick, anybody? Right? How about all the new tax codes for this year? Right? No one's hands are up. That's normal. Okay? This is not a do-it-yourself type of thing. Think back to when you were learning how to crack an egg for the first time, a real egg. Think back to when you first learned how to crack that egg. You don't know how hard to tap the egg, tap too soft, tap too hard, egg splatters everywhere. You get shells in your bowl making the cookies, right? It's a mess, right? First learning how to crack an egg. For some of you, you were learning when you were 5, 6 years old, making cookies with your grandparents. Some of you may not have started cracking eggs till you're in college. Think of this like your nest egg, like you're cracking open your nest egg. All right? There's no second chances when it comes to cracking open your nest egg. You have trouble with a real egg, so what? Pull another egg out, practice some more. Crack that one wrong, pull another egg out, practice some more. With this type of egg, there is no redo button. There aren't 11 more eggs in the carton that you can practice with. There's no practicing with your real nest egg. You only get to crack it open once. What you need to ask yourself is, do you trust yourself to crack that egg open? Or do you want to work with someone who's cracked open thousands of eggs for thousands of people and can just crack yours like you've been doing it for 10 years? Right? Pretty cool stuff. So, we strongly advise you to work with a professional when it comes to putting this comprehensive plan together. You only get one chance to do it right. Okay? This is a very, very good way to crack that open. I'm going to open it up for questions here in just a second, but if you don't mind, pull out your evaluation forms quick. I want to walk everyone through that. Now, I'll save everyone some pen strokes here. If you received the flyer in the mail, that means we have your address, of course. Don't worry about putting your address down. We already have it. Put your name down, though, so we know who you are. If you are here tonight because you came with a friend or a neighbor or a coworker, someone from church, if you're here tonight because you were invited by someone else, then definitely jot your address down because we probably don't have it yet. And if you'd like to be on the list for future seminars that we're doing, estate planning, tax planning, college savings, all those sorts of things, jot your address down. Now, like I mentioned in the beginning of the seminar, I want you to do one of two things. Either put your phone number down or don't put your phone number down. My hope is that everything you saw here tonight was impressive to you. Okay? I hope that this seminar gets you thinking about your retirement money in ways you haven't thought about it before. If the way I explained time horizon and sequence of returns and dollar cost averaging and wove it all into the growth and income buckets, if this is the first time you've seen that sort of thing presented that way, imagine what our firm can do for you when we personalize it to your specific situation and really put a plan together. If any of this gave you that aha moment today, if that light bulb went off in your head saying, I never thought of it like that before, and this was just generic, imagine if this was for real, how we'd make you feel about your personal money. So I'm asking you, if you want to set up a time to get together, jot your phone number down, we'll give you a call. If you don't want to get together, don't write it down, and we won't call you. Now, I know what some of you are thinking. Some of you are thinking that you're not going to write the phone number down because you want to call me instead of me call you. You're thinking, I won't write it down, I'll just give Ben a call next week, we'll set up a time. If you don't write your phone number down, there's probably a less than 5% chance we're actually going to get together, even if you have good intentions right now. Because what will happen is it all sounds really good right now, you're really excited right now, but you're going to wake up tomorrow morning and life's going to be busy just like it always is. And then a week will go by and you wouldn't have called me. And then 2 months will go by and you wouldn't have called me. And then 2 years go by and you think, gosh, who's that guy I went to at that one seminar? What was his name again? It's time for me to retire. What should I do now? Okay? Jot your phone number down and we'll get together. That's the most important thing you can do tonight if you're interested in meeting. Okay? On the bottom of your evaluation form, you're going to see a grid that says morning, afternoon, evening, and then Monday through Saturday. If Tuesday mornings and Thursday afternoons work best for you, then just check the boxes on the grid that correspond best to your situation. That way when I call you up, I've got some different times kind of looked at on my calendar that correspond best to when you're available. If you're retired and pretty flexible, just circle the whole thing. And then I just know to give you a call and we'll get together at my earliest convenience, right? You guys know who you are. All right, so with that said, thank you very much for coming out tonight. I'll stick around for some questions here. We'll do a little Q&A and be around here very soon to pick up all the evaluation forms, okay? All right, thank you.